It might sound a little bit exaggerated, but if you look back at history, silver has always been the money of the people. It has been taken away or demonetized since the mid to late 60s in most Western countries. But I think that if you look back at 1980 and 2011, you had two major crises there. The first one was the dollar crisis. As some people probably don't remember. I don't remember it, but I've read about it that in the late 70s, like 78 and 79, the U.S. Treasury issued what they called Carter bonds. They were U.S. Treasuries denominated in Swiss francs and Deutschmarks because no one wanted dollars. So yeah, in 1980, January 1980, yes, the Hunt brothers did try to corner the market eventually, and the regulators stepped in and stopped people from going long silver, and it stopped that speculative move in silver up to 50. But Paul Volcker was the chairman of the Federal Reserve, and I've read that he's commented after the event that there were some brokerage houses that were in trouble that could have gone under. It could have brought probably the whole banking system under. And eventually he had to allow short-term rates to go to 20% a few months later, or back in 81, 10-year treasury yields rose up to 15.5%. So yeah, I think silver was like the canary in the coal mine, so to speak. And in 2011 as well, when we almost touched 50, that was right at the beginning of the sovereign debt crisis in Europe, of the PIGS, which was an acronym for Portugal, Italy, Ireland, Greece, and Spain. And eventually, in the summer of 2012, Mario Draghi, the president of the ECB, he came out and said, we're going to do whatever it takes to save the euro and stop this sovereign debt crisis from spreading. And whatever it takes, of course, was money printing. It wasn't raising rates like Paul Volcker did in 1980, because nowadays, Elijah, there's so much debt in the system that you can't raise rates anymore to solve a crisis. You've got to cut and print more. Nowadays, the debt is so high, raising rates doesn't solve anything. They raised rates in the 80s to bring back investors into the dollar. They did that in 1992 here in the UK as well. When the pound collapsed, they raised rates to try to attract investors. They reversed those hikes very quickly. But nowadays, the system is so leveraged that they have to they'll have to cut or print more. And what a move towards 50 or even above 50 in silver, which I think is highly possible, would signal as a crisis. I don't know. We will find out. I think it will probably be afterwards, just like it was kind of in 1980 and in 2011, or it could be concurrent as well. And what could it be? Well, you were asking me about the Japanese government bond market. It could be that. Japanese long-term government bond yields have been spiking massively in the last 18 months. They've gone from being near zero and sometimes even negative, like in the 10-year, to now being 1.6 in the 10-year and above 3% in the 30 and 40-year. In Japan, the Japanese government debt to GDP is like 250%. And I've even read, Elijah, that rice prices in Japan, they've doubled in the last year. And that's like a staple of their diet. So the Japanese central bank, the BOJ, is really between a rock and a hard place, because they can't really cut, because their CPI is running like at 3.5–4%. While they're highly significant, the 35 level was like a really big resistance. We tried to break through there twice earlier this year and it failed. And as you said, it's like almost 14-year highs. And there are a lot of speculators and traders who use these momentum, these breaks of very long-term levels as a way to get into the market, and they push the market higher. I think it's called the turtle trading system, which was devised in the 80s by a hedge fund trader called Richard Dennis. And he looked at 22 and 55-day levels. If you broke new highs or new lows through 55 days, it was very bullish. But so here we are, we're breaking 14-year highs. So I think it's very bullish. We reached $39 and change earlier this week. It's come back off mainly because I think the bullion banks, the swap dealers, if you want to call them, they're short quite a bit, and they're trying to fight the market. But I think we're going to continue to see the market move higher. They are kind of under control right now. But I saw, Elijah, that SLV ETF a few days ago, and it was Bob Coleman who posted this on X. Apparently, the bullion banks are unable or were at a certain day not to borrow the shares to go short. So things are very tight, and a lot of physical silver is being drained from the London Bullion Market Association, or LBMA. We are at very long-term lows in terms of inventory. I think it's only 155 million troy ounces. So yeah, the technical picture looks good. I think the next target could be in the mid 40s, and we could see that quite soon, I think. So the other thing is that silver seems to be now outperforming gold slightly, and that's always positive, not just for silver, but even for gold going forward. Of ground inventory, you're making excuse me, it's more profitable right now to scrap silver because the price is going up, but I still think it's not really that great. So that's going to push things even higher because the deficits that the market has been running in silver, that will be negated in years, not in months, because there's not too many primary silver producers, and to start producing silver takes time. As a silver mining explorer, it takes years to drill for the silver, and then to get all the permits and everything. And then you've got the political risks, like in Mexico. Mexico is a big producer of silver. I saw recently that their government are not going to issue new licenses for I think it's open pit mining, or it could, So the other thing, it takes a few years after you drill for the silver. You got to build the plant and then start processing. Taking it out of the ground, it takes 3, 4, 5 years. So the prospects, fundamentals are still good, supply and demand for silver. And on the other hand, I think silver has been capped down through the infinite amount of paper that the COMEX and LBMA create via their, it's called, I think Eric Young called it the COMEX LBMA exchange for the physical doom loop. And I think that's coming under pressure. So that will drive the price higher as well, because they're not really trading real physical silver there. They're trading paper. And eventually, when people really need the physical, they're going to have to cover their shorts. The silver market has got a lot more depth in the past. I think it was last week they did that. It would have driven the market lower, and it would have stayed there for maybe days or weeks. And it was only a matter of an hour. The market came right back. And I worked as a futures and options broker for government bonds. I did trade a bit of commodities, gold and silver as well. But if I got an order from a client, a big order, the client usually used to tell me,